Hey, good day, and welcome to Chapter 13 of Business Finance. Here we go. After my faux pas, when I didn't have Chapter 13 showing on the D2L homepage, the assignment, and I kind of thought that we would be done with assignments by Chapter 13, I realized, no, we got another chapter. We get to do some more problems, and I know how you guys love problems, and so away we go. This is kind of like a late April's Fools, and for that I'm sorry, but yeah, and these are some good problems. I don't kind of mind this. We get into a little bit of statistics here, and for those of you that had statistics, I think you'll recognize some of our work with standard deviations a little bit, and we're also going to talk a little bit about beta, which is going to get into the second project a little bit, and beta is a number that you guys might be interested in, and I'll actually do a separate video today, I think, about project 2 that maybe will deal with some of those issues. So you guys had quite a few problems here for chapter 13. 1, 2, 4, 8, 13, 16, 17, and 22. So I did some that were similar. Your number 1 really just deals with calculating the covariance. What is it called? Not horrible. Now I'm thinking about statistics now, and so I'm not getting the coefficient of variance, I think. Yeah, I was thinking of another term, but yeah, so we got the coefficient of variance, and the coefficient of variance is simply the standard deviation divided by the expected value. And if you look at your problem, number 1, it just gives you the list, right? And it tells you that your expected values are 2200, 2730, 2250, and your standard deviations are 1400, 1960, and 1490. Just make a column like I did, right? Expected values, standard deviations. I just use smaller numbers. You could add zeros to these and it'd be closer to what you guys have, but it makes a little difference, right? Your formula then for calculating the coefficient of variance is simply equal to the standard deviation divided by the expected value. Bingo. Isn't Excel great? And then we can simply, because that formula is going to stay the same and we want our references to move, away we go. Okay. The higher the coefficient of variation, the greater the risk. At least that's what we assign it here. And so it wanted us to rank them, right? Now, which will I select? If I'm risk adverse, I'm going to accept, or I'm going to look at this project down here, right? Because it's got the lowest coefficient of variation, and so I would accept this one as being my lowest risk. Now, it talks about, and this is kind of good to know. It talks about beta when you get to page 426. You're looking at that, and we're talking about the coefficient of variation, but it's also looking at beta, and it talks about beta, and that's something that we'll use on our project too. So just briefly, common stock with a beta of 1 is said to be equal risk with the market, and I don't think of it as risk. I think of it as volatility. So a coefficient of 1, when we talk about a beta, it's a little bit different than the coefficient of variation, although it's really calculating similar things, but. So a 1 means that it moves in tandem basically with the Standard & Poor's 500 stock market index, and something that's greater than 1 would mean that it moves more so than the S&P. If the S&P went up 1%, it might go up 1.5%, say. Okay, and conversely, something that has a beta lower than 1 would move less aggressively than the S&P. And that's something we'll look at with your guys' projects. So just kind of wanted to touch on that, and onward we go. You guys have also problems number 2 and 4, and I think 2 and 4, I think I did 3, which is really very similar. And we get into some pretty good, math, some pretty good statistics here. And what we look at is 3 says, Samsung Corp is evaluating the introduction of a new product. The possible levels of unit sales and the probabilities of their occurrence are showing. what's the expected value of unit sales for the new product, and B, what's the standard deviation of unit sales. So it's asking us to calculate two things. First, the expected value of unit sales. Okay, based on these sales and our projections of sales, and our projections also of the probability of those occurring, right? So we think that there's the highest probabilities that we're going to have a high response to our new product, that the sales are going to be 55, and we think that that's a 40%, right? So all we're doing is taking our probabilities, and our probabilities here when we do something like this are always going to equal 1 or 100%, right? If I do a sum there just to check it, right, it's always going to equal 1 or 100%. Okay, so this is simply then we're just taking our probability times our sales, and so simply go boom, and you can do it either way when you multiply probability times our sales. And again, because our references are going to stay the same, we can copy this on down. Okay. But now we got to calculate the standard deviation, and standard deviation is really all it's saying is what's the normal deviation from this number. This is our expected value now. It's a little bit less than our high response, right? What's the standard deviation of these when we apply the probabilities, okay, from this number? Okay, and so we want to calculate that. That's kind of important to know. We get trend lines and things like that going when we have statistics. I don't want to get too much into the statistics. I'd make you guys long for your statistics class again, and you'd want to come back and take it once again and study some more of those things. But and the way to do that first is we take these expected numbers that add up to our total, though, and we see how far they are away from our total. Okay, and we do that. I'm sorry, we take these numbers, which are expected sales in units, forgive me, and we see how far away they are from our total here. We'll apply the probabilities a little bit later. Okay, so this is just simply equal to our 20 minus our expected value 53, and it gives us that number. Ooh, you know what? What I should have done is making that this E6 here. Okay, I'll hit my F4, and that'll put dollar signs there, because that'll make the reference to this static. Okay, and that way, you know, this reference will move down, but this reference will stay static, and so I can go boom, and it gives me these numbers, right? These numbers are pretty meaningless. Okay, it just tells me really how far away these are from our expected value, right? Either a plus or a minus. And then I'm going to square those. And the only reason we square them, as you'll see later, we take the square root. But the only reason we square these is because we want to take these negative numbers and make them positive. How's that for a lot of work? So, okay, easy way to do a square. There might be a formula in there. I'm not sure. I don't know that I've found it. But an easy way to do this is just simply hit our equal sign. Click on the number that we want to have squared. Hit your shift key and the 6 key. Above the 6, you'll see a little tent thing. Okay, and then hit to the second power. You know, if you're working on some other problems, you can take it to the third power, fourth power, or whatever exponential number you'd like. But in this case, we're just going to use that the squared, which is 2, or to the second power. We hit enter. And once again, I'm going to square each of these, so my formula is going to stay the same. My references need to move, and there we go. Okay. Now I go back, and since these numbers, none of these applied the probability that I'm estimating, I do need to apply the probability here. And so that's all I'm doing here. I'm just saying that this row is times D, or times the row D is what I mean. So it's my F squared times the probability. So equal to probability times, and you can do it the other way. Put them in whichever order. And there we go. Okay, and once again, I copy that down, and then I can total this. All right, hang on, let me put a line under that, and then we'll come down here and we'll total this. 231, and simply, I got it here twice, I don't know why, but then we simply find the square root of this. Remember, we squared these just to get it positive, and we applied the probabilities. Now we're going to take the square root of this, and that's going to tell us, you know, what the standard deviation is, okay, of these four. Small problems like these, you know, it's probably not as big a deal. When you get into bigger and lengthier problems, or lots more data is what I should say, you know, knowing standard deviation, know how far away from the norm things vary, can be really important, right? It gives you levels of volatility and those types of things. So this number, by the way, is called the variance. I use that sometimes in stats, but here we've got standard deviation, which is simply equal to the square root of this, right? And to find the square root, we can come up here and we can hit this, and if you go to the math and trig, it might be under statistics too, because it's obviously something that we use for a lot of things. But yeah, come down here to square root, there it is. Okay, it asks us what number we want to take the square root of, and we want this number. We click OK, and there it is. And this is just the rounded off version of that. It's the same thing, but we've rounded it off. So either number would be correct. So my two answers are 53 is my expected value, and 15.2 is my standard deviation of this particular set of data. So there you go. That should help you guys certainly with problem 2 and perhaps problem 4. Let's go take a look at 4. Yeah, yep. 4, you need to calculate the standard deviation, right, in order that you can then come back and, I did 5, I think, here. That'll give you a good example of 4, okay, so that you can calculate the coefficient of variation, okay. And so I did 5, which is going to be similar, so rather than talk you through it, I'll go ahead and show you. So 5, which is just like your 4 basically. Al Bundy's evaluating a new advertising program that could increase shoe sales. Good for Al. I thought, wasn't he a serial killer or something? Was that Al Bundy? No. Is he a star on some cartoon show? I don't know. Anyhow, possible outcomes and probabilities of the outcomes are shown next. Compute the coefficient of variation. So what do we have to do? Well, to get the coefficient of variation is the standard deviation divided by our expected sales, right, our expected number. And so we're given this information, which I've just put in a nice order here, right? And I got my units, and my estimated sales, and my probabilities for each one of those. And so just like I did above, now I take my probability times my units. Times my units. And there we go, and I can carry that down. Okay, and then I sum those. Okay, I've got to add all those. 8 plus 30 is 38, plus 42 is 80. But I can let the Excel do that for me too, right? Okay, and then remember, I take my units minus my expected, so I get a value here, and that's simply equal to the units, my projected units, minus my overall expected value, or overall expected sales. Okay, and and again, I should have hit my F4 there so that I would put that in, and it would keep that reference the same, and I copy that down. And then just like above, I square this number, right? So it's equal to this, shift 6 key to the second, enter. And again, I can copy that down, so I get that. I take this then times my probabilities, equals this times my probabilities. I can copy that down. I take the sum of that then. So I got 320 plus 200, so that's 520, plus 1080 is going to be 1600. But I'll let Excel verify my number. There we go. And then all I have to do is take the square root of that. I could probably actually about do that one in my head, but we'll go ahead and run through her here. And we'll go to most recently used, and I got square root right at the top. and my square root of this number, and that's equal to 40, but it wants to know what my coefficient of variation is. Remember, the coefficient of variation is just my square root divided by my expected value. So I simply say this is equal to this, my standard deviation divided by my expected value, and I get 0.5 for my coefficient of variation. Okay, so that should help you guys with your number 4. And then you go on to number 8. Ooh. It looks like I did number 7. 8's 5 investment alternatives have the following returns and standard deviations of returns. So you get the returns, expected value, and you get the standard deviation. So really, all you got to do is calculate. You know, this one's pretty easy. I did 7, which is the same. Exactly the same, except the numbers are different. But list my numbers, you know, my A, B, C, D, E, or my alternatives. List my numbers, list my standard deviations. Remember, my coefficient of variation is simply equal to my standard deviation divided by my expected value. Okay. And there you go. And by the way, I had gone in and you know, oopsie. Sorry. You know, you could have just one decimal place and it doesn't give you a lot of information, right? And 2 is a little bit better. You know, I kind of went to 3 just because I wanted to see and make sure, right? And I better identify, I think, what's going on there. So my lowest risk, and it says for 7, it says have the following return. It says using the coefficient of variation, rank the 5 alternatives from the lowest to the highest risk. And I had mine numbered 5, 4, 3. This is the lowest, was 5. I go ahead and identify, you know, which you do, because you may, you know, you may choose. Where's that nice color that I had there? I'll be darned. I think it gave me different colors. Yeah, well, we'll go there. Light pink, right? Okay, so I got 5 as my lowest and 1 as my highest risk. So you should do that with yours too, right? And identify which one's your lowest and highest, because you may rank them, or you can, if you rank the highest and the lowest and put the other ones as 2, 3, 4 or something, that's fine. Okay, so that one should be relatively easy. Then we go on to number 13. Woohoo, 13. Awesome. Lucky 13. Waste Industries is evaluating a $70,000 project with the following cash flows. The coefficient of variation, so it gives us that, is 0.847 based on the following table of risk-adjusted discount rates should the project be undertaken. So I did just a similar problem. I just made up my own numbers. I just said I had a $40,000 investment, and here's my cash flows, right? Okay, all we're doing here is really, I put this as my coefficient of variation is 0.732. Your guys' is 0.847. So you look at page 444, look at your chart. My coefficient of variation is the one right in the middle. So it's the 7.732 is between 0.51 and 0.75. So my discount rate is 10%. Okay. It's that simple, but then it asks, based on the following table of risk-adjusted discount rates, should the project be undertaken? So I got to do a little more work, right? And I got to go back, and it just tells me, it says compute the net present value, so it tells me what to use, right? Okay, so I got to go back then and calculate the net present value for those cash flows using that discount rate that I got from the chart that they provided. I click OK, so my rate's the discount rate, and my values are these, right? Not counting my investment, just my expected cash flows. Then I'll compare that to my investments. So this is equal to my investments, 40,000, and I'm going to hit plus just because of the way I have my pluses and negatives in there. And so I'm 659. You know, you can just look at it and tell this is 40,000 is my investment. I'm only going to get 39 and change, so that's not a good deal, right? So I'm not going to make that investment because it doesn't even reach my discount rate. I can further confirm that by doing my old IRR calculation. You guys don't have to. It's not asking for that, but it's always good practice, you know. Just grab my values, all of them, right? So my internal rate of return is 9.45, less than my discount rate. So it just confirms that my return is not going to equal my investment, you know, based on a net present value or an internal rate of return. So I would decline this particular investment. Your guys' results may be completely different because obviously you have different numbers, but the process will be the same. Whew, here we go, number 16, Debbie's Dance Studios. They didn't get as original with that name as they do with some of the others. I don't know, what were they thinking? They must have fallen asleep. Okay, and I'm like that. I just put in some numbers. I didn't find one that was close enough, so I kind of put in some numbers, and mine's similar. I think I got mine backwards. I could have had my cash flows here and my probabilities. I should have flopped them, but oh well. And I just made up some numbers. My probabilities are 20%, 40%, 30%, and 10%. Okay, and you wouldn't have to list them as percentages, but you certainly can. And my cash flows based on each one of those are 3,000, 6,000, 7,200, 9,000. So like I did, remember on some of these other ones where I applied the probabilities, I want to get my expected value. Okay, and so I apply my probabilities, which is simply taking the probabilities times the estimated cash flow. Okay, and that then I can carry on down, and I get a total here of $6,060 for mine. Okay, now that's, and this is the red flags. Boom, 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 or the siren thing should be going off or whatever, and everybody should wake up at this point in time. Please, if you've been sleeping, wake up, because then it tells you in the problem, it says that will be the cash flows for the next 5 years, right? Okay, so what we come up with here, right? Okay, what we come up with here is going to be our cash flow for the next 5 years. So that's all I've done, is I've taken this and I've made a 5-year cash flow, 1, 2, 3, 4, 5. Okay, and it's going to be the same. Okay, it's different than some of the other problems kind of, and so this is where a lot of mistakes kind of get made. So, and your guys' number obviously will obviously be different, okay? But I take my $6,060, and I said that I'm going to have a $24,000 investment. And once again, should I buy that if I have a cost of capital or discount rate of 15%? The best way to do that then is to calculate my net present value. In fact, it asks me to calculate the net present value. So I'll delete that. And I'll click on my net present value. My rate tells me is 0.15 or 15%, and I didn't have it entered anywhere there, so I can just enter it into the problem. That's fine. And my values are those 5, right? Okay, 1, 2, 3, 4, 5. I click OK. There it is. And I said my investment was $24,000. I'm only going to get a net present value of $20,000 for that 5 years. That's not so good. Okay, so I don't like that. Okay, so I wouldn't invest in that. Okay, and I did the IRR again, you know, just to kind of confirm it came in well under the 15%. This is what I'd have to have for a discount rate or cost of capital, something like this or less, in order to make that worthwhile. Bingo, there we go. On to number 7. I like number 17. We get to compare mines. It's kind of cool. Okay, so 17, Highland Mining and Minerals Company. You're going to take up, you're going to be happy that Excel lets you have big spreadsheets on this one, and it's setting it up that takes you a little bit of time doing the work then, because Excel does all the work for you. It's so nice. Excel's such a nice gift that we have. Imagine when we used to have to do all these things by hand. You guys are too young to remember. Anyhow, here we go. So I made up my own numbers. I said it's Montana and Alaska, and you guys have Australia and what is it? Australia and U.S. Okay, so you're comparing investments. You're a big international firm, right? There you go. Okay, so here's the important thing: when you set this up, you do have to set it up and put in all the years here. And you got to read it carefully. It says the Australian gold mine is going to cost $1,649,000, produce $353,000 per year in years 5 through 15. What's about 0 through 4? Oh, it's not going to start producing until year 5. Holy cow! So you're going to have a lot of upfront costs. You're not going to get any money for a while. But then it's going to be $353,000 for 5 through 15. That's actually 11 years. Okay, I know that sounds like 10, but use your fingers. You got 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I ran out of fingers. So one more would be 15. So it's 11 years, right? There we go. And then I'd have another 10 years of 800,000, or for you guys it's 503,000. So again, I use different numbers, but I put in here. So then for my Alaska, it's kind of like your guys' is Australian, right? Yep. And you guys got 1.6 something million, and I got a $2 million investment, but I get 0 for the first 4 years, just like you. Okay. Then I put in 400,000. You guys will be what, 353? Is that right? Enough zeros there. There it is, right? Okay, and I started on 27, so I'd go through 37 would give me 11, right? I look over there on the left-hand side. There I am at 37. Okay. You know, and a nice way to do this too might be to just number this, right? Got payment 1, payment 2. Okay, after you get 2, then you can go like that. Kind of highlight both of those with the left click, and then you can grab this, and it knows that you want to count. Okay, so this would be a cool way to do it too. I don't know why I didn't do this. Okay, so you got payments 1 through 4, right? Payments 5 through 15. You can see it kind of lights up over there. It's kind of cool, or it gets highlighted. And then payments 16 through 25 are different. I use 800. You guys have 503, right? Okay. And then it says my U.S. gold mine, in my case the Montana gold mine, it's got a different investment, but it's got an equal cash flow then for 1 through 25. And your guys' is what, 282? I got 300,000. And this one I can just drag down, right? I can grab that 300 grand and drag it down for the 25 payments. There we go. Okay. And then it simply says which investment should be made. Note, looking at present value factors for this problem, you need to work with the concept of a deferred annuity. So it's just telling you that yeah, you're not going to do this. So you could do the easy way, or the hard way would be to do a present value for each one of these cash flows based on the number of years you have to wait until you get it, or you can simply do a net present value calculation, right? Okay. And so I'm going to hit delete. Your guys' cost of capital is 13%. I think I'm going to use, what do I got? I'm going to use 12. We'll see what happens. Hopefully that's what I use. Okay, so I'm going to do my net present value calculation. Click up there, net present value, awesome. Rate. Excel is so cool. Values, start there. Click on down here. Search. There we go. So I get 2,335,000, and my investment was 2 million. So I would net, on a net present value basis, actually $335,000. Not too bad. Okay. Let's take my Montana mine then and do the same thing. We'll do the net present value of that. Rate again is my 12%. My values are my 300,000 for the 25 years. 2,352,000. So actually, my income, the net present value of my cash flows is just about identical. But then we got to come back up and look. It's a little cheaper to do the Alaska mine. I find that hard to believe. A little more expensive to do the Montana mine. And so, which one's a better investment? In that case, I would choose Alaska, right? Then it does say, if the Australian mine justifies an extra 2% premium over the normal cost of capital because of its riskiness and relative uncertainty of cash flows, does the investment decision change? So if this were 14%, right, a 2% premium, does my net present value down here change? Let's take a look and see. Okay, use net present value. Use that 14% now as my rate because it's a little higher, a little riskier up there, we say. grab those 25, click my enter. Oh yes, it changes, right? Now, actually neither one of them is worth a darn now, right? So I decline both of them in this case. Your guys' answers may and probably will end up being different, but you know, that just gives you an idea of what happens when you apply different discount rates, and you do that for different things because projects do take on different risk characteristics. So there you go. Where are we at now? 17. We just got one left to do, and that last problem isn't really a problem. You guys just have to do some thinking about it, but we'll kind of go through it, talk you through it maybe a little bit. 22 says this. It says Trainer Pie Company is a food company specializing in high-calorie snack food. It's seeking to diversify, big word there, important word there, its food business and lower its risks. Another important thing there. It's examining 3 companies: a gourmet restaurant chain, a baby food company, and a nutritional products firm. Right? Okay, each of these companies can be bought at the same multiple of earnings. The following represents information about all the companies. So you'd probably want to, I put in just a little brief information here. I think I got the expected earnings and the standard deviation, right? You might want to put in the other stuff just so you have a good record of it. Sorry, and list it, you know, Trainer. This is Trainer. You know, this one is Gourmet. Okay, so on and so forth, right? And then you go through and it says, using the last 2 columns, compute the coefficient of variation. That's what we did up above, right? Standard deviation. That's what this is. You know, insert a symbol. Oh gosh, see if I can go find that standard deviation symbol really quick. These are a pain to insert some of these things, just so you know. Watch this. Look at that. It's just, it takes it way up there. I don't know what the heck it does, why it does that. I don't know. Look at that. I have no idea why it makes that so big then. It must be something that I'm doing wrong. Maybe you guys can tell me. What in the heck am I doing wrong? Okay. I have no idea. And I don't know if I can make this smaller or something. Huh. It's just crazy. Craziness. Okay. So anyhow, that's the standard deviation that would go up there. I'm going to back that out so that... Ooh, I don't want that. Ooh, let's just hit. Okay, so this would be standard deviation that would go up here. I'll do it this way. I have a devil of a time with that in stats class, trying to get those symbols to work out correctly and stuff. It's just a pain, and I don't understand why. I don't know. Okay, and up here then we had the what, expected sales? Yeah, expected earnings. Ooh. Gosh, I'm so good. Here we go. Okay. So you figure out your coefficient of variation, right? And discuss which company is the least risky. So you need to tell me that. Which company is the most risky? So you only got 4 companies. Discuss which of the acquisition candidates is most likely to reduce Trainer Pie Company's risk. Explain why. You got to go back and do a little reading on correlation. I'm not going to give away all the secrets there, but you got to take a look. It might be common sense too, just kind of looking at the different offerings that are there. Okay, you might be able to figure it out in a common sense firm, but so do the first couple of questions there, and then take a look at the data. You don't have to do any more math, really, other than the coefficient of variation. Just take a look at the data, and you should be able to tell me then which company would actually offset Trainer Pie Company's risk. So there you have it, another exciting edition of Business Finance. I hope you enjoyed it as much as I enjoyed bringing it to you. And a little later today, hopefully, I'll put out a little video talking about Project 2. I want to actually pull up your guys' companies and maybe take a glance at some of those and show them. So thanks for listening, and have a wonderful week.